Last week's budget session had several standout announcements, like the crypto tax, or the introduction of the digital rupee, or a focus on drones. But one major announcement was that the government would be spending 7.5 lakh crore rupees this year. That's a 34.5% increase from last year. Wondering how this massive spending spree will impact us? Welcome back to Revolution Read On, a daily podcast where we break down one story from the world of business and finance. Here's your story for today. Government spending is crucial for any economy to grow. After all, when the government funds projects like infrastructure development, hundreds and thousands of people get employment. When these people get employed, their spending power increases, so they buy more goods and services. This in turn helps the companies providing these goods and services, so they hire more people who then spend more. This virtuous cycle ensures that money is constantly being pumped into the economy and it keeps growing. But this is a tricky business. It could also have some negative consequences. How? Most countries, especially developing countries like ours, cannot bear the entire cost of expenditure themselves. So, they borrow money from other countries and their own citizens through government securities and bonds. To fund this year's massive spending spree, the government plans to borrow 11.6 lakh crore rupees, which is 2 lakh crore rupees higher than last year. Sounds like we're falling into a debt trap? That's because we kind of are. Thanks to our increased borrowing throughout the years, this year, 9.31 lakh crore rupees, or half of our tax revenue, which is 19.35 lakh crore rupees, is set to go just to pay off our interest on debts. And with the RBI and other central banks set to raise interest rates to control inflation, the government may have to pay a much higher interest next year. Now you see why we didn't get an income tax deduction. Since the government will be borrowing more, the yields or returns on bonds have shot up as people are expecting more bonds to hit the market. Currently, the bond yield has reached a 2 year high of 6.9%. This is also thanks to the Federal Reserve announcing that it will be increasing interest rates soon, which could potentially cause the stock market to tumble. You're probably thinking, surely that's good news. Bond investors will be so excited. Well, future bond investors are, but not the current ones. The rise in yields has caused debt funds to enter negative territory. This is because many existing investors sold their bonds, plus the rise in yields wiped off a major portion of the market value of these funds. Huh? You see, bonds pay a fixed interest rate. If it's 5% today, it will be 5% next year as well. So then, how are yields rising? That's the magic. When yields rise, what basically happens is the price of the bond decreases. Let's take an example. A 5% interest rate on face value of 100 rupees wala bond will always give you 5 rupees as interest every year, regardless of its price. But say the price of the bond in the market becomes 90 rupees. You can effectively buy a 90 rupee bond to get 5 rupees interest, which is technically said to be a yield of 5 rupees divided by 90 rupees, which is equal to 5.55%. So, existing investors are at a loss. The bond that they bought for, let's say, 100 rupees is now worth 90 rupees. Therefore, the market value of the funds that debt funds had held has declined. Plus, the investors are also kind of at a loss. They could have gained the same interest for 90 rupees, but they've already paid more. Not just that, if they now go to sell the bond, it will be priced below the value that they had purchased it for. So they'll have to hold on to the bond till maturity. Okay, so there's no harm in that, right? That's the catch. You see, if these investors keep holding on to these bonds, a part of their income is tied up. So they won't be investing or spending this income, preventing this money from entering the economy. Plus, thanks to the high yields, more investors will invest their income in bonds. So, the government's ultimate aim of increasing public spending has kind of fallen flat on its face, no? But that's just one side of the coin. This doesn't mean that more government spending will not actually boost the economy. It will still add lakhs of jobs and create better public infrastructure for us. However, the government should be careful in balancing out its debts, borrowings, and expenditure. Otherwise, it could mean a big disaster for us in the future, as the government will have to increase its earnings by taxing us more. An ever increasing fiscal deficit could also cause a major economic crisis. Do you think the increased government borrowing this year was a good idea? Let us know what you think. Thanks for listening in to this episode of Revolution Read On. We'll be back tomorrow.